Good afternoon, KW Prosperity. It is Mary Beth and myself, Matt, alongside John Rondi to get an update on the mortgage industries. Thanks for coming on again, John.
Yeah, sure. My pleasure, guys.
It's Monday Mortgage
how's your
with John
weekend?
Rondi.
Mondays with
Yeah,
Ron.
yeah. So, you guys had a good weekend? Everything's good?
Yeah.
I'll tell you. So, just to get right to the point of things, we talked a week ago, and I know you talked to other guys as well, and everyone formulated their opinion as best possible, as well as being as insightful and optimistic as possible. Well, I don't know. The whole week went by, and I think I know less now than I did last week because there's been so many additional changes that it's hard to process. And I'm not going to sit here and tell you guys I profess to know all this stuff. I don't. And the reality of it is the rates are so very inconsistent. It's hard to communicate to borrowers a message that's comforting at times because you want to be transparent. And so if you're a 20% down borrower, great credit score, closing in the next 30 to 60 days, you have less to worry about. But if you're that borrower that, again, has credit issues, less than 20% down payment, and some moving variables around the rate lock window, that kind of thing, that gets a bit dicey. So, FHA is an example, which for minimum down buyers has been a real safe haven, has been a real safety net by way of credit scores, right? So a credit score on an FHA, you could get done in typical manner, 580, 600, 620. We've just been told that benchmark has been raised. So the bar is going to go up to 640. Not only with that benchmark comes some other variable changes such as reserves. You never had to have reserves for an FHA loan. So now they're asking for 2 months reserves on FHA loans. And that's just a sneak preview of other things that are gonna come. So let me not bombard and bulldoze through this, but you guys tell me what do you want to hear? What can I kind of help out with? And
Are the conversations you're having with various people, buyers, agents, are they changing since we last spoke last week? What are those conversations now like? What are you experiencing?
Well, I mean, the conversations would be consistent in that, the message is clear. It's a great time to buy, right? Rates are low. And, if you have the resources and the time to put all this together by way of those logistics, such as, well, how do I get into a property to see it, right? How do I get an appraisal done? Is it a waiver? Is it somebody that's going to, work with you in the sense that, is very, necessary now. Those types of things are all relevant, and those are still, it's a great market. So, hey, let's all keep doing what we're doing. Title companies are doing the best that they can. I've seen some title companies of late express that they're having a hard time getting their searches done, which makes sense because a week ago they weren't saying that exact same thing. So now everything's kind of piled up on one another a little bit. But outside of that, it really is business as usual, aside from those things that are going to affect my world and the underwriting of my world a little bit more intimately.
Well, let me ask you a question. We just got off a national call that we have weekly on Mondays, and they were just sharing with us about just the overall financial thermostat and what on a national level some companies are doing, where we're seeing so many layoffs and people are just getting, jobs are being put on hold. Income is probably all over. And also we were talking about how liquidity is going to be the name of the game coming out of this. Those companies, those mortgage companies that are liquid will be able to do different things that maybe some shops that will go under in a time like this. If you
Right.
if you don't have the income coming into your shop for the next couple of months, how do you foresee John Rondi and Harbor One continuing business? Because I know that
Well,
you will.
well, again, we touched on some things last week that I coined as being a selfless plug. Okay, so you're right. And the reality is, we are a bank. You have money today to lend, you have leverage. And that's a fact. And there are plenty of my friends that are on the broker side. There's plenty of my friends that profess to be mortgage bankers and have warehouse lines. Fact is, if it's not your money that you can then lend and in turn service, you lose, right? You lose some of that span of control. That's fact. Likewise, I have very good friends. I worked at a very big bank for over 23 years. And the big banks are trying to control capacity. The big banks are trying to control their risk and minimize things. So they have money to lend in the portfolio sense. However, they are juggling and trying to still decipher through what that all means when you hedge the markets, right? When you try to maintain your profit share, when you try to deal with your shareholders. So on the very big side of this, you have big, strong bank that has a world to deal with, and you have smaller banks that contend with it on a similar way, but the capacity is not always the same. I'll give you one example of something that, although it's not relative to the purchase world, it's relative to the economics of things. So without mentioning names of the big bank, there's a big bank that I'm very intimately and intimate with and know very well. They stopped originating, just flat out said, we're not going to take any more of these kinds of loans. And the kind of loans that they're not going to take anymore are loans with an 80 LTV or higher that are looking for cash out. So if you, one of your friends, someone said, hey, I want to jump on some low rates, I want to pull some cash out, pay off a student loan, I want to pay off a car loan, this one institution is not in a position to do that today, because that's how they're deciding to hedge, leverage, control capacity, and that kind of thing, which is
well, and I'm sure protect the ability to even have a company if they're not as liquid as maybe some other companies. A couple months could knock them out.
Yeah, well, you know what it comes down to also, you have to have a market in which to sell it to, right? So yeah, you can only spend so much money. You can only have so much money to lend. The idea is you want to relieve yourself of some of this obligation and sell it to Fannie Mae or Freddie Mac. You want to recycle it so that you have the opportunity to lend, again, that same amount of money. And in this example, that market, that segment for lending with that bank just doesn't exist. They're not doing it, period. Also has to do with, in all fairness, it has nothing to do with the bank solvency and whether it's a good or a weak or strong bank. It has to do with inspections. So to the end of, well, when you need to get an interior inspection, this bank doesn't want that liability, right? Not my bank now, for those who just maybe tuned in here, not my bank, but the big banks, they don't want that liability of saying, well, we needed to get in and we sent somebody in and now something happened. So that there's that ripple effect that's real, right?
Mm-hmm. And so to the customer right now, like you said, the rates are all over, and
Right.
I think what you're saying is, if you're not the ideal borrower with great credit and 20% down, you may have some challenges finding a
Right.
product that fits for you.
Right.
But maybe what's another example of something that you have seen in the last week that was like kind of shocking to you, like, oh geez, well, we can't go that route.
Well, the most shocking thing for me has been how sensitive the credit score is. So, you know, a credit score of 800 is ideal, right? That's your gold, your 5-star. And you can get over 800. You could be just below 800. But if you're around 800, you're gold. 740 was the benchmark. And I've seen credit scores at 720, which is still very good.
Mm-hmm.
And it affects in the slightest pricing that I can't figure out why. And I think I know why, and I don't need to get into all those details, but it just happens. It has to do with the end game, the market, and its saleability, and some of the things with pricing that those who control the throttle on this are pumping the brakes a little bit. And so we're just seeing some interesting dynamics, if you would, between borrower A and co-borrower B, and sometimes having to do a rescore of their credit or even taking someone off of a loan so that we don't have to average out with the lowest score of the two borrowers.
So you make a really good point there, and that's something that I know of, but it was good to be reminded, is the lower score of the two borrowers. That may be something that some people have to be talking about, is taking off somebody on an application. The second thing is, it sounds like we should be talking with you to even see.
Yeah, absolutely. There's more that needs to be put into, and again, I don't know if this is a fair assessment, but you tell me. I would think there's less activity now, right? Realtors, mortgage people alike have more time, although the time is being spent a little differently, like doing some of these calls, we're filling in the blanks, we're talking, we're trying to be creative and be proactive and get ahead of it. All that good stuff is happening because we're not going to sit by idle. But I mean, the real day-to-day activity has changed. And I don't know that it's fair to say that everyone's slow or everyone's picked up in their pace. I don't know where that falls, but I think that your role now as a realtor, as it relates with your mortgage lender, has got to be a little stronger than it was. You need to talk to, you can't just take that letter from ABC company and just say, okay, it's good, I'm good to go now. You might want to pick up the phone and really dig in deeper, or you may want to challenge and say, well, thanks for this letter, but I need you to talk to John Rondi. I need you to talk to my person, just as a comfort level before we go, too much further, to make sure that there's no slipperiness of this. And I'll give you one other real example that is, it's more relative to my side of the business, I guess. And we talked about experience last week. I'm doing this 30 years. Mm-hmm. Not everybody in the mortgage industry is doing it as long as I am, and that doesn't mean that it's a benchmark of being better than somebody. All it means is it's experience, right? You have some people that are in this industry on my side of the ball that have never seen this. They've never been exposed to this, and they don't know what it means, nor will the people who they're being led by understand what this means, the magnitude. So they think, oh, everything's fine. Well, things may not be fine by the time you turn around and close the loan because of yet another guideline that changed. And I just gave you two examples since we spoke last week, right? Two things. One was the FHA, the other was the cash out refinance. Those are changing, moving principles of variables of lending, right?
So to the point about the credit score is, what are some things that affect the credit score? What are some things that our borrowers can be paying attention to? I personally just increased mine, and I've been on a journey to increase it. And so, and it was amazing the things that opened up when it hit. The 7,
well, what did you do? So, okay, without getting too personal, to answer your question, one of the things to do is just pay down your cards, right? Pay down your debt. Don't pay them off totally. Don't close them out, because that doesn't always, most of the time, it doesn't help your score. So one thing a consumer can do is pay down your debts, but don't do it in a random fashion. Have some science behind it, right? These are algorithms. You need to contact someone like myself who can run the credit, be educated and talk through the credit, and also use the services that are available that'll be available through us as lenders, not necessarily the same through you as a consumer. The ones that you'll use as a consumer are going to cost you money. Okay, it's going to be significant. It could be $30 a month. It could be $100 a month, and they're very useful. But the shorter, quicker answer is, well, just talk to your mortgage guy and let's take a deep dive in, and let's use the repository, the lending service company that we use, and they'll help us walk through it, and then we'll provide the supplemental information after that is executed, and we'll see what happens with the score.
That's great. That's great advice, and it's a great resource. Something else that I was able to do, which definitely helped, was call the credit cards that I do have, that I have zero balance or a balance and ask them to raise the limit to actually give myself more credit.
Right. What I've also found is that if you're an authorized user on an account, that's not necessarily good either. So if you're on an account where someone else has debt, you might as well take yours off of it. That'll help boost your score up.
Yeah.
Right.
All right. So we can call you. We can tell our clients and our own agents to talk to you if they're considering doing some stuff. And
right.
Okay.
Yeah.
I would also say I've seen some articles just about different banks or mortgage companies where you can, there's a grace period for not having to pay your mortgages for, or not pay them, but basically defer them. Do you want to talk a little bit about that? Because I've seen that online and I've seen different verbiage around that and like what people
buyer
should be
beware
doing, shouldn't
there,
be doing.
Beware.
I've seen a lot of questions about that and I've seen things phrased very differently in different places.
Well, so everyone's sensitive to where we are. Creditors are doing everything they can to help give relief. Government's offering their form of the same relief, right? And small businesses are giving out those loans where applicable to help pay for payroll for employees. I don't know if you guys are familiar with that or not, right? So that's great. Well, mortgage lending institutions, big servicing companies are saying, well, we'll let you relieve yourself or relieve it for the next 2 or 3 months. They're not doing that because they're nice, right? They're not just going to let you get away without making a payment. You have to, first of all, you have to be approved to do it. They have to say you can do it. You can't just arbitrarily think, oh, I don't have to make my payment. They've got to go through the steps and register you for that. And then what they'll do is they'll take your payment and they'll put it on the back end. So that's one of the options. They'll put it on the back end, or they'll give you another option of dispersing the payment over the next preceding X amount of months. So I've heard of 2 different types of doing it. The one I'm more familiar with, which is most common, is just saying, well, we're going to put the payment on the back end. Right?
Great. Thank you.
Yep.
Yeah. And to John's point on that is not every bank is doing it. Not everybody qualifies. And some banks are only deferring, and we are also only talking about mortgage principal interest. We're not talking about taxes, insurance. So some of those that have a mortgage payment that is all encumbering the costs, you may get yourself into some trouble with the sheriff if you're not paying attention.
Well, that's the other point, right? So if you just took it on yourself and said, well, I'm going to give myself some form of my own relief and not pay the mortgage payment, well, the taxes still need to get paid. That mortgage servicer still needs to pay those taxes. So they have to exit. They have to figure something out, right? They have to just call your servicer and they'll give you whatever options they're doing. Everyone's, willing to work and do something.
That's right. Okay. So what else is going on in your world? How's the crew? How's your company? Shiny working?
Everyone's working. Everyone's great. I mean, not like we're one of the lucky ones. The challenges we have are the ever moving components, variables, logistics of getting through. We're all busy writing loans, talking to people, qualifying them. There's activity, but there's also a lot of confusion. There's a lot of things that just when you figured out, or you thought you figured out what was going to happen with regards to a guideline or a change, something else happened, and it's making you a little dizzy. It's making me just pump the brakes on certain things and just say, all right, well, again, can control only what it can control and can't worry about some of those people. Unfortunately, as I said earlier, the FHA requiring reserves is a big move. Raising the bar of the FICO score on an FHA borrower is a big move. Holding firm on certain things that are relative to each lender by way of what was once an exception 30 days ago that you would get without hesitating. Today, you're not getting it. You're just not getting as many exceptions as you did, 30 days ago.
All because of the fear of risk, right? When risk,
it's
just the risk.
Yeah, it's the manage of the risk. It's the managing of the risk and how each company again decides if they're going to control their own capacity, control their, and the shareholders as bank, as the banks are related, and so that's how it goes.
Right. What are you listening to? What are you listening to? What are you watching? How are you keeping your mind
Oh my
and
God.
everything in the last
TikTok.
week?
TikTok videos. We're doing a
No,
lot of
not
TikTok.
TikTok.
Yeah, we are. So I'm not. My kids are doing a ton of them. And yeah, I mean, the days have gone so fast for me.
Mm-hmm.
Literally all day, all
Yeah.
week, Saturday and Sunday. It's been a blur. It has been a blur, and I'm having to call people back 2 or 3 times that I knew I talked with. But I'm like, okay, just refresh my memory because let's go through this again. And so that's my own habit and practice because I don't want to miss something or forget something with a borrower. But outside of that, it's just, we're just getting dumped on with this link and this person's idea or thoughts behind what's going to happen. I don't know who to, yeah, I guess you listen to everybody and then you find out in weeks to come who was right. So.
Well, we
Because
hope
they
we
all
get to
can't be
see
right.
you back in the office
Sooner
as soon
than
as
later.
possible.
Yeah.
Yeah. Yeah.
Yeah.
What do you guys think? I mean, how much longer is it going to be? Right? I mean,
Yeah.
Well, we are prepared right now for the next 30 days. We've been encouraged to do a 30-day, a 60-day, a 90-day plan. And right now we're in our 30-day plan, which is going to just kind of take on April and have a virtual calendar and a virtual value added to
right.
our agents so that then they can be adding value to their clients. And we're going to just stay safe and stay in. Now, with 1 month down, I believe that the agents can really build up their pipeline. They
Right.
could put some deals together virtually. We're seeing that.
Yep.
And right now we're seeing things that were listed still be able to go under contract and use the new process. I just said to Matt, in the next couple of weeks, we'll see how many listings actually really come on and say,
Right.
I want to be in
Right.
this
Right.
market.
Yeah.
I don't know, but that's
Right.
going to
Right.
change things because they'll come in at a certain price. They'll adjust to a certain price.
Well, even if you're looking at like our daily update, like we only had one new listing that came on. It was a rental. I think it was, it was rentals, but we did have, I think, 4 or 5 under contract. So things are still going under contract.
Yeah.
The listings just aren't
So
coming
the other thing that we saw over the weekend, and Bill was sharing, he got like 5 calls in one day about New Yorkers wanting to
Yep.
move out of New York City into the burbs.
Oh, really?
And Tang Ho also mentioned that he had somebody ask for a 3 to 6 month rental because he can't take his kids because his kids keep going in and out of the house and he can't afford to get sick. So he just wants to leave and go to his
Oh my
own
God.
3 to 6 month rental. So this is what's
Wow.
going on with some people, right?
Yeah.
Then of course there was a chat back and forth on the New York comment because a few agents expressed, no, that's not a good idea. Let's not get involved with moving people across state lines right now.
Yep.
I don't know. There is a lot of opinions out there, right?
Right. Okay. So let me ask you guys, how you're doing a lot of these Zoom calls, right? You're doing a lot of different levels, and again, this has become the front line of your communication, which makes sense. And it's great.
Yeah.
And we're doing similar. We do it through Skype, and we're trying to get into the Zoom thing because Zoom works better outside of the walls of our bank, right?
Yeah.
Okay. So
Mhm.
Skype is interior. It's easy, whatever.
Right.
How are you finding this type of communication to be effective wise? I mean, I don't know if I'm looking at this correctly. It says Pat Lowe is on. So that means Pat is just listening and tuning in, right? Or she's on the line somewhere. She doesn't have to talk. I'm just curious.
Yeah.
So that's
No. We actually have just the 3 of us. Our video is being shown and our audio is being shown. Everybody else is muted or video down so that we
right.
can have this recording and then we can have these moments for the rest of our lives to share with
Yeah.
our grandchildren.
Well, and that's it. I think, John, like to answer your question, like I think it's effective in the sense that people that want to come on live can come on live. However, we've
Right.
converted all of these videos into YouTube links and they get
Right.
posted and shared on Facebook. So even if there's 5 people on a call or 10 people or 1 person on a call,
Right.
I've noticed that as days go on, the views on
Mhm.
YouTube will go from like 5 to like 20 to 30 to 40.
Oh, okay.
So
Right.
people do plug in. It's just it may not be live. So I think it's an effective way
Well,
of
that's
communicating. It's just different. maybe delayed.
That answers my question. Yeah, that answers my question. Because I
Yeah.
mean, it's great we're talking, but if there's no audience or if there's no value that's being perceived on the other at that side, then maybe there's got to be a different way of, I don't know. So okay, but you're obviously tracking that.
Yeah, I'm seeing it more like almost like kind of like a Netflix or, like where people like we have a whole shift series we've done daily, and I've posted like, hey, if you want to catch up, like we've done 5 of them, the 30-minute videos.
Right.
People can binge watch them and catch up. So I do think that it's nice because the content doesn't. It's not like an in-class thing where once you're done with it, you're like that's out in the in here. It's like once it's here, we can use this for months on end if we wanted to direct people back to it.
Do we really want to reflect back on these?
I don't know.
These weeks. I mean,
No.
I don't think so.
I personally am struggling with it in that I am a hugger and an energy feeler. So I'm struggling a little bit with it, and I find that these Zooms that we have set up on a regular schedule for me for the week is something that I need as well as I think some of our agents and our leadership need. And that just creating that new normal schedule and modeling it for them that we're sticking to it is still, creating habits around a schedule. So
it's showing, it's your leadership. Sure. Yep.
Yeah. And
All right, give me a hug. Give me a hug. Give me a hug.
Virtual hug.
Hey, Mo Anderson says 7 hugs a day or it gets weird, and she doesn't even care if they're virtual hugs. So.
Oh, you could do that. All right, good.
I just got 2 right now. 2 of my 7.
Yeah. All right. So let's we're gonna talk with John again next Monday, and I'm sure there'll be new stuff. So we'll talk about what came up this next week, right?
Okay, you got it.
You have a great week, John. Thank you for sharing.
Bye. Take care.
Okay, bye-bye.
All right, bye.
Bye.